Good morning, everyone, and welcome to the AASB's Income of Not-for-Profit Entities Getting to Know AASB 1058 webinar. Presenting today is myself, Sean Steenkamp. I'm a project manager here at the AASB. And with me today is Clark Anstis, an assistant technical director, who also had a lot to do with this project. On the agenda today, we have a fair bit of information to cover. With that, I would like to hand over to Clark Anstis, who will take us through the project update of where and how we got to where we are today.
Very good. Thanks indeed, Sean, and my welcome also to everyone who has joined the webinar this morning. The Income of Not-for-Profit Entities standard culminates a very long-running project. No one can complain that we have been too hasty in establishing this standard. The AASB issued in December 3 standards as the outcome from this project: AASB 1058, titled Income of Not-for-Profit Entities, which is the main standard. Accompanying 1058, there are 2 amending standards: 2016-7, which defers the application of the revenue standard AASB 15 for not-for-profit entities until 1 January 2019 instead of 2018. And also AASB 2016-8, which adds specific not-for-profit guidance to both AASB 9 and also to AASB 15 to assist in their application by not-for-profit entities. The effective date of 1 January 2019 means that for entities which have the typical financial year, July to June, the first year of mandatory application is the 2019-2020 financial year, which sounds a long way off, but it will come. The AASB issued about 5 exposure drafts in relation to this project. The first 3 exposure drafts, which aren't referred to on this slide, were issued through the 2000s, and these were expressly looking at amending AASB 1004, the contribution standard, which is largely replaced by AASB 1058. In June 2009, the board issued, in conjunction with the New Zealand Accounting Standards Board, an exposure draft, in our case ED 180, which followed the approach in a standard issued by the International Public Sector Accounting Standards Board. Around 2010, when the AASB was considering the responses received to ED 180 and taking decisions as to how it would address the issues further, decided that in its view the AASB was close to finalising its new standard dealing with revenue from contracts with customers. So the board decided that it should wait to consider whether the approach in the AASB's revenue standard would be a better approach to addressing income of not-for-profit entities. Alas, the AASB then took another 4 years to complete that project, and hence the long delay before ED 260 issued in 2015. So the ED proposed an approach which follows IFRS 15, and that has now been finalised through the issue of AASB 1058. So it has been a long process, and it's culminated in some standards that will apply from 2019. The principal reason for undertaking this project is that for a long time the board has heard concerns about AASB 1004, the contribution standard. The main issues really address premature recognition of income. So you will know that AASB 1004 addresses receipt of resources by a not-for-profit entity, and in particular it refers to contributions in terms of reciprocal and non-reciprocal transactions. So a contribution is defined as a non-reciprocal transaction, which is both parties to the transaction don't receive equal value in the exchange. And the common approach under AASB 1004 is if an entity receives a contribution, a grant or donation from another party, And even if there's an expectation as to what the entity ought to do with those resources, typically the accounting under 1004 has been to recognise revenue or income upon receipt, because the standard does not permit the recognition of obligations for the activities or actions that the entity has agreed to perform. So the complaint here is that while the initial recognition of income does not reflect the substance of the transaction in many cases. And of course also with the recent issue of additional standards, AASB 15, the revenue standard, and also AASB 16, the new leasing standard, there arose questions of, well, how do those standards interrelate with AASB 1004? So there has certainly been a significant impetus for the board to finalise this particular project. Sean will address a number of these areas in more detail further in the webinar, so let me just highlight a few of the key messages here. In particular, one of the outcomes of AASB 1058 is that there will be many more circumstances where it is appropriate for the recipient of resources to recognise an obligation, and in doing so, that would therefore mean that income is not recognised immediately, and hence the reference to deferral of income. But just as a footnote here, which Sean will address further, an obligation that is merely time-based is not sufficient for deferring income. In other words, a pure matching approach is not supported by this standard. If you have recognised an obligation, then in due course income is recognised when those performance obligations have been satisfied. So it's necessary that the performance obligations are specific enough that you can identify when those obligations are satisfied. AASB 1058 also makes amendments to the other standards which address the recognition of assets. AASB 116, property, plant and equipment, AASB 138, intangible assets, AASB 140, investment property, for example, are standards which presently say that a not-for-profit entity that acquires assets subject to those standards for consideration that is nil or nominal consideration should be recognised at fair value. AASB 1058 makes amendments to those standards and other asset recognition standards to require the measurement at fair value where assets are acquired at significantly below fair value. So this expands to some degree the requirement for fair valuation of assets upon acquisition. AASB 1058 also clarifies the approach to leases that are established on significantly below market terms. In these cases, the lease asset is required to be measured at fair value, and that will be addressed further in the webinar as well. Not-for-profit guidance is added to AASB 15 to assist entities in applying that standard to contracts with customers. The terminology in AASB 15, of course, is oriented towards for-profit entities due to the focus of the ISB. So this appendix helps to translate that for not-for-profit entities. And I'll just clarify too that much of AASB 1004 is in fact deleted by AASB 1058. So AASB 1004 will still exist, but it will have very much more limited requirements only for certain types of public sector entities. So not-for-profit private sector entities will no longer need to refer to AASB 1004. This slide is the big picture. So you can see there the three standards that have been issued in respect of this project. AASB 1058 relies upon other standards. It relies upon other standards for the recognition of assets and for the recognition of credits in respect of the assets. So the credits might relate to lease liabilities, contract liabilities under AASB 15, provisions, contributions by owners, decreases in assets, whatever other standards might produce. So 1058 then says, well, having recognised your debits and credits according to other standards, then the difference between those represents income to be recognised. So if you're able to recognise an obligation for agreed activities when you receive a grant or other resource, then that will of course mean that the amount of income remaining to be recognised is reduced. The standard does also admit the possibility that in fact the credits might exceed the debits, in which case you would have an expense. AASB 1058 also addresses capital grants. Now this is a shorthand tag for transfers of a financial asset to enable the entity to acquire or construct a recognisable non-financial asset to be controlled by the entity. That's such a mouthful, we conveniently refer to those as capital grants. So if you receive a grant for your entity to construct a building or purchase a building for your purposes, then that transaction most likely does not come under AASB 15 because there's no agreement for the transfer of goods and services to other parties, and hence AASB 1058 clarifies that in that case you can actually recognise an obligation for your agreement to acquire or construct the non-financial asset. The standard also addresses volunteer services. Now note carefully that it's the same requirements as in AASB 1004 presently. That is for local governments, government departments, general government sector and the whole of government. Volunteer services are required to be recognised where they would have been purchased had they not been donated, and secondly, the volunteer services are reliably measurable at fair value. So those requirements are unchanged from AASB 1004, but what is different is that AASB 1058 clarifies that all other not-for-profit entities can elect to recognise volunteer services, and particularly just a class or classes of volunteer services. So that wasn't clear under AASB 1004, and that optional recognition requires only that the volunteer services are reliably measurable. So there's no requirement that they would have been purchased had they not been volunteered. Looking at the two amending standards, AASB 2016-7 just defers AASB 15, the revenue standard, and its consequential amendments to 2019 for not-for-profit entities. So it gives a bit of breathing space for not-for-profit entities to address both the new standard 1058 and also the revenue standard to apply from the same date, given that they're really meant to work in tandem. AASB 2016-8, it provides amendments to AASB 15, adding Appendix F to AASB 15, and Sean will address many of those requirements further. Amendments to AASB 9 to address the initial recognition of non-contractual receivables as if they were financial instruments, as if they were financial assets. So this is adding Appendix C to AASB 9. The reason the appendix is necessary is because the subject here is non-contractual receivables, and of course financial instruments and financial assets are defined in relation to contracts. So this new Appendix C will address the initial recognition of receivables such as income taxes, fines, local government rates and so on, which are not based on contracts but through statute or other authority. That's sufficient for me to give you the overview for the project and the new standards. So I'll now pass over to my colleague Sean to take you through some more of the detail. Thank you very much.
Thank you, Clark. And as Clark indicated, I will take everyone through the Appendix F to AASB 15, which provides the majority of guidance in relation to contracts with customers. So during the process of developing this new guidance for not-for-profit entities, the board really wanted to identify aspects of AASB 15 that are challenging for not-for-profit entities to apply. The challenge primarily comes from the terminology used in AASB 15 and its focus on contractual arrangements. Many not-for-profit entities inform the AASB that it's not always clear in the not-for-profit space whether a contract exists, and in many cases people often don't think that there's a contract in the first place. So across the top of the slide are the 5 steps of the AASB 15 model, beginning with identifying a contract with a customer, continuing on with identifying separate performance obligations in that contract, determining the transaction price for the arrangement, allocating that transaction price, and then recognizing revenue when performance obligations are satisfied. The AASB primarily identified 3 areas where not-for-profit entities could benefit the most from additional guidance, and that is in the first instance here with identifying contracted customers, secondly identifying performance obligations, and finally allocating a transaction price. In the first step of identifying a contract with a customer, it's usually asked, who is a customer of a not-for-profit entity, especially when you look at the guidance in AASB 15. And secondly, well, what is a contract? And in many cases, not-for-profit entities do not think that they've entered into contracts at all. So in relation to a customer, the board decided to clarify that the customer is usually the party that has promised consideration in exchange for goods or services. In the not-for-profit context, however, there could be a third party to those arrangements, which could be the ultimate beneficiaries of the not-for-profit entity's activities. So a typical example is a donor providing funds to a not-for-profit entity that will use those funds to assist members of the community and not necessarily the donor themselves. The clarifications to AASB 15 for not-for-profit entities, this additional guidance, clarifies that such an arrangement is not necessarily outside the scope of AASB 15 merely because the donor doesn't directly receive benefits. Secondly, the board added additional guidance in relation to enforceable agreements, which is one of the key characteristics of a contract. Typically what you'll find is contracts that require a refund of the cash received would be considered to be enforceable in many cases. However, a refund obligation in an arrangement is not necessarily the only characteristic that makes an arrangement enforceable. For example, a donor might be eligible for a right for compensation of some sort if the not-for-profit entity does not perform or deliver the goods or services as promised. The donor might retain a financial interest in the assets provided to the not-for-profit entity. For example, if a donor provides a van to a not-for-profit entity to use in laundering those clothes of people in need, if the donor retains an interest in that van and is able to take that van back should the not-for-profit entity not use it as promised, that also indicates a enforceable agreement. Another is whether the not-for-profit entity must seek approval from the donor to expend funds in different ways. So funds could be provided on condition of being utilized in one manner, and if the not-for-profit entity for some reason needs to expend them on another purpose, if that not-for-profit entity needs to seek approval for that other purpose, that is also indicative of an enforceable agreement. So as you can see, an enforceable agreement is not necessarily a contractually legally binding arrangement. There are many features that could cause such an arrangement to be within the scope of AASB 15. The board also added additional guidance that the agreement might be enforceable in terms of written arrangements, but there might also be a valid expectation of performance of either party in an arrangement which is not necessarily written down in a formal contract. The next area the board decided to provide clarification on is identifying separate performance obligations inside an arrangement. These performance obligations, again, may be explicit or implicit in the entity's past practices or documented activities. The key underlying feature of identifying a performance obligation is the ability to know exactly when the entity has actually satisfied that performance obligation. So as Clark mentioned before, a time-based performance obligation where funds are transferred merely to be used as long as the entity is in existence is usually not sufficient to create a performance obligation. The only time the entity would know that it has satisfied its performance obligation is upon liquidation, which is not a valid argument in this case. That brings you to the requirement and the guidance that the performance obligation must be sufficiently specific to determine when it is satisfied. A couple of extra points the board added to identify whether something is sufficiently specific is for an entity to consider the nature or type of goods or services being promised, the cost or the value of the goods or services, the quantity being promised, or the period over which the goods or services must be transferred. So what we'll do now is go through an example, and now this is example 3 that accompanies AASB 1058. There are numerous examples in the standard. This one is quite useful for our purposes to illustrate whether an arrangement is within the scope of AASB 15 and whether there is a transfer of goods or services, and then also identifying performance obligations. So in this case, an alumnus transfers $2 million cash to a university as an endowment. The university may use and invest, the university may invest that $2 million at their discretion, but must maintain or return the real value of the principal amount contributed if the terms of the arrangement are breached. Investment income must be applied to scholarships for students. So when looking at the first requirement in AASB 15, we need to identify whether there is an enforceable agreement. Share the results. So as you can see, 88% of everyone agreed that there is there's an enforceable agreement. And I'll take us through some of the rationale as to why that is the case. So you'll see on this slide that the amount is required to be returned to the alumnus if the terms are not met, and breach of the requirements is enforceable by law or equivalent means, meaning that the contract indicates that the principal amount must be returned should the university not perform as required. Next, we need to identify if there is a transfer of goods or services to a customer. So in the first instance here on the left of the slide, you'll see we're talking about cash scholarships. And the question is there whether or not cash is considered a good or a service. So if the university merely provided a few $1,000s to a student to use during a semester to acquire textbooks or anything else, general living expenses, that is generally not a transfer of goods or services. It's more like a financial instrument arrangement, and therefore AASB 9 is likely to apply. In AASB 1058, this situation specifically is considered in example 3A. The next question is whether a promise to provide student accommodation, on the other hand, is actually a transfer of goods or services. So in that case, we will open another poll to seek your opinion on that. So I'll quickly show those results. So we have 90% of everyone agreeing that there is a transfer of goods or services to the student. As you'll see on this slide, examples 3B and 3C of AASB 1058 consider that particular fact pattern as well, and go through far more detail and describe how AASB 15 might apply to that transaction. If we expand the fact pattern just slightly in relation to these examples, we can have a look and see or assess the situation against the sufficiently specific criterion for a performance obligation. So in this case, we have an example where university is required to provide student accommodation to a student every year for a defined period of 30 years. Now, this might not necessarily be the same student for all of those 30 years. It could be a number of students. So I'll bring up a polling question there as well, and we'll see, what do you think? Is this a sufficiently specific promise? So I'll close that and share the results. As expected, you can see there are about 83% of votes to the affirmative. Looking at the next slide, you will see that is indeed the case. And we have a distinct performance obligation, and the university will be able to determine when exactly the obligation is met. On the other hand, changing the fact pattern only slightly, the university is required to provide a student some accommodation or a student accommodation per year for as long as the university operates. So similar to the first example, this is not necessarily the same student for as long as the university operates, but could be any number. Is this a sufficiently specific performance obligation? And we'll share those results. As you can see, about 66% or 2/3 of those in attendance today said this is not sufficiently specific to be a performance obligation. So we'll have a look at some of the rationale. And as you'd expect, the entity is probably not going to be able to determine when the obligation is satisfied, as it is an ongoing obligation for as long as the university is in existence. So the time at which it satisfies the obligation is completely unknown, and the only time the entity will know is when it's being liquidated. On the next slide, the final place in AASB 15 where the board added some guidance is in relation to allocating a transaction price. Now, there is an example at the back of the guidance in AASB 15 that considers this very question. A typical scenario is where an entity sells tickets to a dinner event. Part of the price of that ticket will probably go towards paying for the venue and for the goods and services that the venue provides, and part of it will probably be a donation. So in this case, the board added some guidance to say, well, there might be elements of that transaction price that is a donation, and there might be other elements that is actually a compensation for goods or services. There is a rebuttable presumption in the standard that says that generally the transaction price is fully allocated to performance obligations. However, that presumption must be rebutted where the transaction price is partially refundable. So that partial refundability indicates that there's probably something more than just a mere donation or a mere compensation for goods or services, and then the entity will need to go further and analyze that transaction to determine to what extent each part falls under a different standard. Finally, what the board also decided to do was, if nothing can fit into AASB 15, an entity is probably going to have to recognize income on day one up front in accordance with AASB 1058. However, the entity might consider that the cash or the donations received are restricted in some form. Therefore, the guidance to AASB 1058 encourages some additional disclosure. It doesn't require it, to allow entities to further describe their financial performance and position. So entities are allowed to split donation income between restricted and unrestricted amounts, and similarly in the balance sheet, any assets or liabilities that the entity considers relating to restricted obligations may also be split out so that the entity can better explain how and why cash has arisen. That brings us to the end of the AASB 15 guidance. Going forward, we're looking at AASB 1058 and how that applies to transactions. On this slide, what you can see is the general model that AASB 1058 applies to transactions. So Clark mentioned first that the primary sort of gatekeeping criteria in AASB 1058 is that the consideration for a acquired asset must be significantly less than the fair value of that asset principally to enable the not-for-profit entity to further its objectives. That's a pretty big mouthful, but what it's meant to cover is any case where an entity acquires an asset under very beneficial circumstances for the purpose of furthering its objectives is a transaction that's going to fall within AASB 1058. On the other hand, if the entity just happens to be lucky at a public auction or routinely receives a trade discount or purchases something in a fire sale, that's unlikely to be something related to furthering the entity's objectives, and therefore other standards apply to that transaction. Where a transaction falls within the scope of 1058, an entity goes through a number of steps to account for that transaction. The first is looking at the debit side of the transaction, where, as Clark mentioned before, there are a number of consequential amendments to other standards that say you need to recognize that asset at fair value. So, for example, if an entity receives a donated van or a car or something to use for its objectives, the property, plant and equipment would require that asset to be measured at fair value on initial recognition. Or where a lease, and we'll cover leases in a further slide, there is also fair value requirements there. So why did the board actually want all these assets fair valued? Well, the main reason is for transparency, accountability and stewardship reasons. And that is, the board considered that not-for-profit entities could better explain their financial position and the resources that are available to them if the assets that they've acquired or received under beneficial arrangements are recognized on balance sheet at fair value. Having said that, it's not always necessary to perform a formal valuation, and when we cover the leases example in just a few minutes, you will see exactly what we mean with that. Fair value is only required on initial recognition, so the standard doesn't require a particular accounting treatment to be applied subsequent to initial recognition. It is only that day when the asset is first recognized on balance sheet that it should be recognized at fair value. This requirement is slightly larger than the scope of AASB 1058 is slightly larger than AASB 1004 was. So as you'll see, there's a note on that slide that says this covers more assets than just those that were required for no or nominal consideration, which was the scoping requirement under AASB 1004. So this standard will apply to a broader range of transactions, but as you'll find later in the slides, there are some significant transition reliefs in relation to that. There are some exceptions to measuring assets at fair value, and in particular that is for donated inventory. So the standard amends AASB 102, the inventory standards, to say that materiality can be applied on an donated item by item basis rather than the aggregate value of that donated inventory in the entity's balance sheet. Therefore, it's possible for entities to determine that donated inventory on an item by item basis is immaterial and therefore does not need to be recognized once it's donated, and instead the entity will recognize income at a higher profit margin once the inventory is actually sold. So this will cover typically op shops and things like that. Looking at leases, the board was fully aware that many not-for-profit entities are entered into what's termed as a peppercorn lease arrangement, where the not-for-profit entity receives, for instance, floor space in a particular building and pays a very small amount of rent, well below market rates for that floor space. For that reason, the board decided to add additional guidance to 1058 and also to 16 in relation to examples, AASB 16, about applying the standard to a peppercorn lease arrangement. Essentially, what will happen is the entity needs to apply AASB 16, which happens to become effective at the same time AASB 1058 does, and says you need to recognize the right to use the leased asset at fair value. The lease asset in this case will not equate to the lease liability, which would be the present value of the actual cash flows for that leased asset, and therefore the difference is recognized in accordance with AASB 1058. The difference that we keep talking about is your credit amounts. So once you've recognized your asset on your balance sheet, say $100, you need to recognize your what's termed as related amounts in the standard. So these are all the other credits. This could be a AASB 15 contract liability. It could be a AASB 16 lease liability, could be a provision, or some other credit that gets into the standard. Once you've recognized all your related amounts, you look at the residual that's remaining and determine whether that residual is in relation to an arrangement to acquire or construct a non-financial asset. This is the capital grant scenario that Clark mentioned previously, and we'll get to that in a minute. So if it's not a capital grant, then the entity recognizes income immediately for the residual, which is anything left over after recognizing related amounts in accordance with other accounting standards. If we apply this logic to a peppercorn lease, you will see that in this example, a charity receives or enters into a very below market lease for 30 years with the local government and pays nominal rents for that period. On lease inception, the charity will recognize a right of use asset at the fair value of the right to access that asset. In this case, it could be a floor in a building. The right to use that for 30 years could be $360,000. Now, in determining that fair value, it's not necessary to go and get a formal valuation done. If it's in an office building, for example, it could be just as easy to find out what other tenants are paying in that building and determine whether that is a fair value for floor space in that building, and then recognize a right of use asset in that regard. The lease liability is recognized at the present value of the lease payments. This lease liability is one of the related amounts I referred to earlier and is measured in accordance with AASB 16 without modifications from 1058. And in this case, because of the nominal rents that the entity is paying, the present value of that lease liability is $1,500. Going through the model in AASB 1058, the difference being the residual amount remaining after recognizing all related amounts is recognized as income in accordance with AASB 1058 on day one of entering this arrangement. And as you'll see on this slide, the difference is $358,000. If the arrangement is in relation to a capital grant, then that difference is recognized as an obligation instead of income on day one. So this is typical in situations such as schools receiving funds to build further classrooms or further facilities on the school grounds, where a local government might provide funding to the school and that funding must be used for that particular purpose. In that regard, the board considered that the substance of the transaction is the donation of the additional school buildings as opposed to a donation of the funds to acquire or construct them. There are some characteristics that must be satisfied under the arrangement before it can be accounted for in this way. So the arrangement must require the school to acquire or construct a recognizable non-financial asset. Now that is important primarily to remove items such as research grants from these capital grants recognition allowances. The final asset that's acquired or constructed must be prohibited from being transferred to other parties, and the whole arrangement must be enforceable in some way. So this goes back to the similar requirements that are in AASB 15. If those characteristics are met, then a liability is recognized for excess of the initial carrying amount of the financial asset over the related amounts. So this is that residual amount I mentioned before. And then the entity recognizes income in profit and loss as it satisfies that as it satisfies its obligations under that capital grant. So for example, with the school, the entity will recognize income as it constructs the asset, and all income will be recognized once the asset is constructed. Those are the main requirements of the new standard. The next issue for entities to look at is the transition options for applying the new standard. There are a number of transition relief that the board provided to entities. So the first is in relation to below market leases, and this is that the fair value of the right to use asset is considered only on transition to 1058, and that consideration is whether it is below market or not. So in this case, the board heard of many not-for-profit entities that have leases that extend many decades, and therefore it would be impracticable to go back those number of decades to find out if at the time the entity entered into a below market lease. Therefore, the entity said that the board decided to provide this relief for transition fair value. There is also another transition exception in relation to transactions fully accounted for under the old AASB 1004. These are termed completed contracts. So if an entity has already applied AASB 1004 to its transaction, those transactions do not need to be restated for AASB 1058. So once they're recorded and you transition to the standard, you do not need to go back to reopen those and reapply 1058 to them. Similarly, as Clark mentioned, the scope of AASB 1058 is slightly broader than 1004 in relation to the consideration paid for the asset acquired. Historically, under 1004, that was for a no or nominal amount. However, under 1058, that is now arguably larger because it refers to the consideration being significantly less than fair value. For that reason, the board decided to provide transition relief that any assets already recognized historically that are in that expanded scope will have their accounting grandfathered, which means the entity continues to apply whatever accounting policy it had for that transaction while applying AASB 1058. The entity does not need to go and rearrange or reconsider that transaction and apply 1058 to it. Finally, similar to AASB 15, AASB 1058 allows entities to select between a full or modified retrospective application. This means entities may choose to either apply AASB 108 when applying AASB 1058 for the first time, which would require an entity to go back and reapply 1058 to all of their transactions, or the entity might apply a modified retrospective application where the entity may choose to just restate or to recognize the effect of applying 1058 on opening balances for the year in which it applies the standard and not have to go and restate comparative information. Knowing all that, the next question for entities is, well, what do we need to think about in the lead up to applying AASB 1058? Entities obviously first and foremost will need to consider when they would like to transition to the new accounting standard. That is to say, will the entity want to apply it early, or will your entity actually wait till it becomes mandatory in 2019? Along with that consideration, entities need to consider any system changes that are required. Obviously, 1004 had one particular accounting requirement, and 1058 now expands that to a number of standards, including other accounting standards that allow to recognize different credits in an arrangement, and that might need changes to systems. A communications plan might be necessary for the entity to describe what is happening to its financial statements in the year of transition and how that might affect judgments made by donors or other interested parties. Your entity might even need to consider whether your existing and future agreements for funding need to be examined in accordance with 1058 and determine what accounting outcome would occur when applying 1058, and if those agreements might need modification to remove ambiguity. Finally, financial statement disclosures can assist entities in describing what is happening in their financial statements, such as those voluntary disclosures that I mentioned earlier about restricted and unrestricted funds. That brings us to the end of the key requirements of AASB 1058. Thank you for your time.